Okay, so those are joining online. Can you hear me? Please confirm. Right, thanks, Duncan. Okay. So you have been taken into a small cage, no? That's how. With time it happens, right? So get used to. Right, so we were discussing about what last week? Basically, we were in the financial system part, right? So we learned about bills of exchanges, bonds, a lot of stuff. So out of these financial products, did we discuss everything? This shares, all these things, right? And bonds. Certificates of deposits, credit agreements, mortgages, bills of exchanges. Question number 4, did we do it? Right. We'll start from here. Right? So when it comes to the shareholders' return, if you do invest in shares, now basically the two basic categories, you can either invest in shares or else you can invest in debt market. So debt and equity. So shares, investing in shares, the return you can gain in two ways, like the capital gain and also what? Dividends. We just learned about that. So when it comes to the debt market or the bond market, calculating the return from financial products, this equity dividend yield, how to get, you know already. I don't want to explain. So when it comes to bonds, there are a number of different ways in which you can calculate the yield on bonds. Okay. So when it comes to a bond, I explained that there's a clear difference in between a fixed deposit and a treasury bill, how that operates. So just like the fixed deposits has a interest rate, the treasury bills is having a discount. How the discount framework works, I explained. So just like that, it's similar to a treasury bond. So the basic difference is treasury bill is for a shorter period, which is it's a money market instrument. And then treasury bonds, it's a capital market instrument, which is like it ranges for a period more than 1 month. So although I explained the treasury bill structure, how the discount rate applies, you should get to know that when it comes to a bond, you can't like wait for like 20-25 years without a return. So although you have money, you can't like lock the money and wait for the next 25 years to earn the return. Unless you are from that Sartaka family. If you are from that, you can wait for like next 50 years to get the return. But if not, you and I can't. Okay. So you should be getting a return on an annual basis. What's the annual return how do we call it the annual return of a bond? What's it? Coupon rate and the coupon amount, right? So face value of the bond multiplied by the coupon rate, you will be getting whatever the coupon interest received on an annual basis. So just like you get two ways of income for a share. So when it comes to a share, okay, so when it comes to a share, you have the dividends and also you have the capital gains, the return, right? So just like that, when you take a bond, let's say it's a 25-year bond, you have two ways of earning return. So on an annual basis, you might be earning a return, and at the end, you might receive the face value. That's how it happens. So what happens in a bond? Imagine I'm like issuing a bond. I'm like issuing a bond. What happens? I'm issuing the bond to you guys. So you guys give me the money. For let's take 25 years. I'll be dead by then. So I don't want to pay. Right? 25 years bond. So on an annual basis, I'm giving you a return. And then after the end of 25 years, I should give you the face value of it. The full total which I have gained. Right? So annual part and then the final. So bill rate, there are a number of different ways of calculating the yield on bonds. Yield means the return. Firstly, the bill rate is face value. Now the nominal value of the bond is $100. Coupon rate is 8%. Redemption terms to be redeemed at par in 5 years' time. Current market value of the bond is $108.40. Which is what happens is, today you purchase this bond for 108.40 by paying 108.40. So how can that happen? So in a treasury bill, what did we do? Let's say $100 treasury bill, we are purchasing at 95. So after like 3 months, I'm getting the entire 100. So ultimately a discount I have received 5. So how come this happened? 108.40 is the market value. And then the nominal value or the par value I'm getting after particular period, let's say in this example, it's 5 years. After 5 years, I'm getting 100. For that, I'm paying 108.40 now. Is that viable? Is that practicable? Why? Think. Everyone, now, imagine there's like somebody is giving me some money, right? So you all are giving me 108.40. I'm telling you, after 5 years, I'll pay you 100. You'll kick in my, no? Then what will you do? You'll give me. He's a poor guy, you know. So, okay, just $8, no, just. What happens here? Actually. So that's okay. That's okay for you to give me 108.40 because I'm a lecturer. Not that, guys. 108.40 is the market value which you are paying today. I am agreeing that I'll pay you 100 after 5 years, true. But what about the annual interest I'm paying? I'm paying you an annual interest for 5 years. So altogether as a package, I'm paying you 100 plus annual interest. So if you know the annual interest earned for the next 5 years, you'll are smart enough, you know discount factors, you know how to take present values. So if you take the present values, if that is more than 108.40, now you're okay. Clear? That's how bonds work. That's okay for me to pay 100 because you have the annual return as well. So bill rate would give you just the return. Coupon rate is 8%, which is the annual amount I'll be giving you is this 100 into 8. So $8 I'm paying you annually. Secondly, running yield. So running yield means annual interest divided by the market value of the bond. So annual interest is $8. Market value is 108.40. You will be getting running yield or the current yield as 7.38 if you compute and calculate. Clear? So if you bought the bond for 108.40, the annual interest of $8 gives a return of 7.38 on your investment each year. Now it's good, isn't it? Right. Note that this approach takes into account the market value of the bond but ignores the impact of capital gain. That's okay. Third factor, gross redemption yield. Gross redemption yield gives the annualized overall return. See, annualized overall return. Now the bill rate or the coupon rate gave you only the annual interest, right? Second one here, Running yield, it also didn't took every factor. But when you take gross redemption yield, it takes the annualized overall return, which is inclusive of coupon payments plus the final payment. So if you calculate this, this is, so I'm not calculating it here, that will come to 6. So how can you calculate this like this? See, if I am to go with that investment, right? Whatever the now you have the cash flows. No, so every year you are getting a cash flow of $8. So cash flow of every $8 for 5 years plus that redemption value, present value of everything, if that is equal to 108.40, I'm okay. Isn't it? So if I am earning more than that, that's definitely okay. So to calculate what's my return is, you can do the reverse calculation, how market value which I'm paying today should be equivalent to present value of all the future cash flows of the bond. So the discount rate applicable there is my return. So that is what they have calculated as 6 there. Did you understand? So today you are paying 108.40. So you can calculate, you know the cash flows. 800. Take everything, calculate the present value of the cash flow, the rate at which that is getting equal to 108.40, which is the market value, that is your return. That is the overall return. So that return, now only the other part we calculated, the return was 7.38. So this would be definitely less because this is the overall rate. Right? So calculations with time to come we'll be doing. So the basic phenomenon, did you understand how a bond works? So present value, how to take the present values and stuff. Clear enough? This role of risk, did I explain last? That part did I explain? Role of risk and this diagram, yield curve, did I do? Okay. So I'm not going to repeat, guys. So I'll have to start from credit rating agencies. This, all right. So this was the diagram now, yield curve. Yield curve was drawn the years to maturity. When the number of years to maturity increases, we want a higher return. That's a common factor. Right? If you go into a bank and ask for a loan for a 2-year period, the rate is less. But if you ask that for 15 years, I need a home loan for 15 years, they will charge a higher rate. So the yield curve is like this, the shape, right? So longer the term of the security, the higher will be the gross redemption yield, the return to the investor. So investor in that sense, you're going into the bank and asking for a loan. Who is the investor and who is the borrower? Who is the investor? Bank is the investor because bank is giving you money. So when the maturity, longer the maturity, they will require higher return because they are blocking up money for a considerable period. So that's what it says. The normal shape of the yield curve would suggest that it is cheaper to borrow in the shorter term. Right? So if you start work, once you start working, if you ever go for a home loan to a bank, going to a bank and asking for a home loan, don't ask it for 50 years. Right? I just need a home loan for 50 years. I just need to build up a mansion. Shorter term. Right? So you'll have to pay less. If not, they will charge the interest rate even your second or third kid will also have to pay the home loan. Got this? Right. For an example, if a firm wishes to borrow for 10 years, then it would be cheaper to take out a 5-year loan and then replace it with another 5-year loan in 5 years' time than to take out a single 10-year loan. Important. Why? That's important. So rather than taking a 50-year housing loan, take 10 years by 10 years. Right? So first kid would pay the second part and third kid would pay the next part, right? So they do say it because of this yield curve. So when you borrow for the short term, the return you have to pay is less. Reason? What decides the return or the yield? No. The single word? Risk. What decides the yield? Risk. So why do banks charge higher interest rates for a longer term? So bank likes to. Bank thinks no. So it's 10 years now you give me this. Is it? It's a risk. Because I told you the structure, banks are lending people's money, depositors' money. So blocking that sort of an amount of money for a longer period is a risk to the bank. So higher the risk, higher the return they need from their perspective. So to match the risk, they need higher rates. So as borrowers, we will have to pay higher rates. Got the whole point? Understood now? Easy. The main reasons why some firms do not do this are, so you can, rather than going for a 10-year loan, you can borrow for 5 years. Then after 5 years, take another 5-year loan. So the main reasons why some firms do not do this is risk. The 10-year loan could be arranged with a fixed rate for a whole term. If 2 5-year loans are used, then the rate for the second loan would be whatever arrangement of fees. Now, if you need some amount of money, there are two options you can go for, right? You can take a 10-year loan, right? You can take a 5-year loan, wait for the 5 years, and then take the next 5 years. You can take 5-year 2 loans, right? 3 options. You can go for a 10-year loan. You can go for a 5-year loan, pay that. After that, again take. Now, if you are doing a home loan, if you are going for a home loan, first take the 5 years loan, then the veranda area, kitchen, and 1 bedroom. Oh, no washroom required. After 5 years, you are only constructing the washroom, again kitchen. You can do that. One option. Or else you can take 1 5-year loan in your name, 1 5-year loan in your dog's name. You can do 2 loans. Wife's part, 5-year loan. Dog's name, 5-year loan. Your name, 5 years. So you have several 5-year loans. Right? So just pay off the loans and die. Right? So several options. There are risks associated in it. So up to that extent, I'm not going to explain. This is not a banking class. So you just get to know that when the tenor, the maturity increases, risk increases. As a result, the rate which they require increases. That's what they say. Credit rating agencies. So what are credit rating agencies? Have you heard of any credit rating agencies here? What? LOLC. I'm not heard of. Yeah, Fitch is doing this. Fitch ratings, Moody's Analytics, likewise. So why do we need credit ratings? What's a credit rating actually? Does everybody has a credit rating? Yes or no? Do you have a credit rating? You have. Don't have. Anybody having a credit rating as to what you think? I obviously have, right? I have a credit rating, very bad. So now credit rating, it's like this. When somebody is going to borrow, right? When a company, think of a company, not us, right? So if you are going for a loan in a bank, definitely the bank will do a credit worthiness analysis and they will come up with a credit rating you, right? Definitely. So when it comes to a business, imagine for the first time, you are going into the bank asking for a loan of like, let's say 50 million rupees. Like we are doing Sivana, so we should work in big numbers, 50 million and likewise, not just 1, 2 million. So the banks needs to assess the risk. Do you all agree? The banks needs to assess the risk and needs to come up with the interest rate for your facility. Now, if I go to the bank, they will give me a rate. But if somebody like Elon Musk or somebody goes to the bank and asking for one, quite unlikely. But if they go, what the rate they would give? We believe Elon Musk, if Dhammika Perera goes, going into the bank, commercial bank, and asking for a loan of 50 million rupees. What's the rate they will give? And the rate they will give to me? If Dhammika Perera goes, he will not have to go actually. Bank will go to his place and give the money, his money. No credit risk arrangement. Assessment required. For me itself, they need. So just like that, for businesses, bank can't rely on their own credit risk assessment sometimes. So as a result, they will have some opinion from some other person, some opinion from some other professional agency. Those agencies are known as credit rating agencies, just like Fitch, right? So Fitch will say, imagine ABC company, Fitch will use their technical expertise, whatever the stuff they have, the methods and stuff, they will say, this company is having a credit rating of this. They are really good. So what banks can do, banks can rely on Fitch and banks can say, I'm not worried about the repayment. So when the bank is giving a loan, what's the basis? Very basic risk the bank is exposed to. Very basic risk. One needs to get the funds back. Yes. Whether this person would run away with the money. Isn't it? So that is known as credit risk, which is whether this person would pay me back or not. So to ascertain that, we need to assess the credit worthiness of the company. So that is basically done by credit rating agencies. If a company wants to assess whether a firm that owes them money is likely to default on the debt, a key source of information is a credit rating agency. They provide vital information on credit worthiness to potential investors, regulators, firm itself. Sometimes we ourselves can assess our credit worthiness using these, and sometimes the banks gives loans, but central bank, the regulators like central bank might ask, why did you give this much? Right? So for that also credit rating agencies are required. Right? Do you think the bank can give any amount of loans to anybody? What's the maximum? Is there a maximum? Is there a maximum? How does this happen? A bank can give any amount to anybody. Let's say they can tolerate. Let's say a commercial bank is lending to John Keels. Both the guys have money. Commercial bank have trillions. They can give. John Keels can pay. Can they give? What do you think? Yeah. Can give or not? So basic stuff, just get to know. Why? Yeah. We are learning about the financial system, right? So that's financial system, everybody is inside. Banks, all companies and everything. So it's true that they can pay. Sometimes they will show that they will prove, they will pay. But there's a maximum limit a bank can give to one particular borrower. There's a limit. There's a single borrower limit, which is for commercial bank. It's like for one individual company, it's around 70 billion rupees in rupee terms. So they can't go beyond that. The central bank says you can't go beyond that. We can't lend to John Keels more than 70 billion. Why? There's a risk. So if one individual, if one company fails, if that loan fails, that will affect the entire commercial bank, and failing in one bank will lead to the failure in every nook and corner in the financial system. So there are limits. So there are methods to go by that as well. So several banks can get together and give a syndicated loan, right? Imagine John Keels needs 200 billion. So 4 banks, commercial, Sampath, NDB or whatever, and get together and they can give. So the risk is distributed to 4. Anyway, what you have to be concerned about is risk. Understood? So although you need, there's a limit. Okay? So credit rating agencies, they are the people who is assessing the credit worthiness. A large number of agencies can provide information on smaller firms, but for larger firms, credit assessments are usually carried out by one of the international credit rating agencies, 3 largest, S&P, Standard & Poor, Moody's Analytics, and Fitch. Right? Rating agencies. Certain factors have been shown to a particular correlation with the likelihood that a company will default on its obligations, magnitude and strength of the company's cash flows, size of the debt, volatility, that's not required. Right? Just for the sake of reading. So if a company, if we are analyzing the credit worthiness, we should analyze the amount of the loan, what's the repayment capacity of the particular borrower, future cash flows, and likewise. How credit worthiness is being assessed. So using this and other data, firms are scored and rated on scale where AAA is the least risky investment grade, which covers AAA to BB, B minus. So it's like this. So these ratings are given like this. The best rating is AAA. Right? So the next will be AA plus, AA minus, A, again plus minus, then B, triple B, BB, B plus minus. That's how it goes. So the best rating is AAA. If that's a AAA rated company, that's the best case. So if it's AA plus or AA minus or A, considerably good. Then B you have, right? Then C, again triple C, CC, likewise. And then you have the default grade. As a country, what's our rating? What's our rating? 4As. Then we were in default, right? We declared bankruptcy. As a country, we declared bankruptcy and we will not be honoring any of the foreign loan payments on 2022 April, as I could remember. But now we are okay. Now we are being rated upwards. Now we are in the C category. Right? By the way, we never were in A. Right? We were anyway in C. So now we are doing good. Right? Now we are making foreign loan payments. So from the default grade, we are being taken into the C grade now. So what's the big issue with this? So this is somebody giving ratings. No, who cares? Fitch and this S&P, anybody can give ratings. No, who cares? What's the problem with this? What's the problem? Now these things you should know. What's the problem of the country's rating being D? Yes? They can't pay loans. Okay. So that's even okay, no? Imagine I'm taken a loan of 50 million. They say my rating is D. And I'm not paying. Yes, I'll go to another island and live. What's the problem? Why the rating is important is in a country, right? If the rating is D, given the any reason, will any other country will give anything to us? Will any country will like to deal with us? At least you are traveling to some other country, right? So you see some tourists, we are the tourists, so you see some natives from Sri Lanka. Look, if that's the case, this person is from Sri Lanka. Don't give food, give money first. Is that the case? Credit rating matters that much, up to that extent, right? So we can't live in the world alone, right? We are not Iran or something to live alone. We are importing everything from other countries. So if they need to like enter into transactions with us, do letter of credit transactions with us, will they agree? If we are having the D grade rating, they will have the perception that we are not paying. Everything goes for a 6, right? So letter of credit means you are having an arrangement to import them. We are importing everything. Apart from you guys here, everything we import, right? Everything imported, so it's a problem. That's how important credit ratings are, right? So understood about credit rating agencies and credit ratings? Clear? Okay. So credit spreads. There's no way to tell in advance which firms will default on their obligations and which won't. As a result, to compensate lenders for this risk, firm generally pay a spread or premium over the risk-free rate of interest. The yield on a corporate bond is therefore given by required yield on corporate bond, yield on equivalent treasury bond plus credit spread. That is important. Look here. I told you treasury bills and treasury bonds is a risk-free item. Not in our country, in other countries. Risk-free, right? Treasury bills, treasury bonds considered risk-free. Why? Not really. Just somewhere there. Yes. If that is being defaulted, the government can print money. As a result, this is considered to be the 10-year government bond rate. Imagine it's 8%. It's considered as the risk-free rate. Zero risk. Right? So if the risk-free rate of the country is 8%, and I live in that country, I as a deficit party need some money. Deficit. Right? There's one of you guys, surplus parties. That's why you are coming and paying money to the wisdom, no? They're surplus parties. Right? So if I need money, what's the best rate I can expect? What's the best rate I can expect? I need to borrow money, right? So in the country, risk-free rate is 8%. Think. In my case, what I expect is you say more than 8%. Yes. Any other answer? Or do you agree? Do you agree? Don't agree for the sake of his saying. You just think for your, right? More than 8% or what? How can you think of that? If I have, not me, this is me, yeah? Deficit. I'm always into deficit part, right? You are surplus parties. Think from your perspective. I wanted to think from your perspective. You have money. You have excess amount of money. Portion you pay to SIMA. Okay. Apart from that, you have excess money. right? If you have money, country, there you can go and invest at 8%, where you don't have any risk. No risk. You can go and invest at 8%. Right? Invest means what? You are going and invest in the government securities means you are giving you are giving money to the government. So the comparison is with who are me and the government. Whether you are giving money to the government or me, definitely you would give to me, no? Isn't it? Damn. Right? So are you going to the government and giving at 8%, or you are giving it at a rate to me? That's the problem. Okay? So this is risk free. No risk. But giving to me is a risk. Because I'm doing the class today, I'm meeting again the next week. What if I migrate during this week? You give me money. You are leaving today after the class and you are giving me money. Everybody gives me 100,000. I'm taking that money and leaving. Not giving a cent. And you can't find me. Is there a risk or not? But when you give to the government, you have 225 people to speak to. Right? You can say this government took my money, give me. You can go to the media, do anything. Can you go to the media and say that our lecturer took money and left? No. They will show a photo of mine in the news. That's totally okay. I'll live in some other island or country or wherever I need. Right? Can happen. So risk is high in don't take me, somebody else. Risk is high with this person. If I need to give money to this person, rather than going to the government and investing, I will require a rate more than 8% or less than 8%. More than 8%. That's what I'm going to say. If I need to give money to you, right, I will need 8%, which is the risk-free rate, plus I will say I will need another 4%. So then I'll change my decision. I will not invest in this, but I will invest in you. For that, I need additional, what do you call this? Additional premium. That is spread. Clear now? Clear or not? Same thing happens the other way also. If I can go and borrow from the government at risk-free rate, right? For the companies, I mean, you don't have to get to know. Imagine I'm John Keels, right? The government is giving me a loan so that you just bring up 50,000 employment to the country. They will give me a loan at a risk-free rate. So if a bank needs to give me, if I am going into the bank and asking for funds, that rate should be below or lower than 8%. Below or lower. To change my decision, that should be below or lower. That should be below. Why? I can always go to the bank and get at 8%. So only if I can get at a below rate only, I will go and borrow. Understood? So you may have to remember this. Remember this. That is called premium or credit spread. So I'd prefer if you can like draw this near the Newton key. If you are like going. If you understood, that's okay. But after some time in the next eternity, when you are doing the exams, sometimes you might not remember. Mark can keep. So this additional 4% is the credit spread or the premium. All right. Okay. So credit rating agencies publish tables of credit spreads detailing, for an example, the same one example being explained here. Right. Question number 5. Did we do that? I remember doing it. Yes. 6 did we do? No. Right. Question number 6 and onwards. Quickly finish. I need to finish off the financial system part today. People say that you have a mock exam in 2 weeks, right? I don't know, but I got to know. I'm not involved in that, right? I'm not preparing questions. I don't want to stress you out. I'm not giving you questions. You have. Only thing is I'm not involved, right? You have mock exam. I heard people saying so. No, that's not difficult, right? That's just 30 questions from whatever we have done, right? So next week, it seems it's a revision day, no? I don't know for what hell of the reason is that. We just completed 2 sections and doing a revision. Come on. But that's okay. We are having a revision session next week. We'll see. We'll give a small revision. Up until the point which we have covered in the class. Yes. So because to study this today's part, you have 7 days now up until the next week. So I'm assuming that I can give question. Not I. Wisdom. They can give questions from this part as well. They give. Okay, they're asking, suppose a company wants to issue some bonds and is concerned about the level of return it will receive. Right? Issue some bonds. Which of the following yields does not need knowledge of a bond's value to calculate it? That's what they ask. So bonds, you can go and purchase bonds. But this time the company is issuing. Companies issuing, right? Companies issuing bonds means they are the people who needs money. Isn't it? Issuing bonds means I'm issuing bonds means I'm the person who is getting the cash flow. In that sense, which of the following yields does not need knowledge of a bond's market value to calculate it? Simple. What? A, B, O, C, D. Those who say A, B, C, D. Why D? So they are asking which of the following does not need market value, right? To calculate the bill rate or the coupon rate, you don't want the market value, right? Isn't it? Face value multiplied by the coupon rate. Answer is C. Understood? Why did you take D? Any specific reason? No. Question number 7. 7, 8, 10 onwards. Quickly do, guys. 7, 8, and onwards. Running. For this question, if you need, you can note down. For question number 6, you can, if you need, you can note down. Running yield and the interest yield, both is the same. Right? Running yield is equal to interest yield, that is calculated as annual interest divided by market value into 100. Gross redemption yield, how can you calculate? Gross redemption yield, market value equals present value of whatever into discount rate. So market value is required to calculate A, B and D all. Bill rate you don't want. If you need, you can mention it. Question number 7. Indicate by clicking in the appropriate box whether the following statements are true or false. Coupon bearing securities have a fixed maturity and a specified rate of interest. Correct or not? Those who say yes? Those who say no? Can't be, right? It's true. Right? It's true because we are having a coupon bearer. Coupon means it's a bond, it has a maturity, right? It has a fixed maturity and also it has a fixed rate of interest. So you can say the coupon rate is this. Understood? If in the discount market, funds are raised by issuing bills at a discount to their eventual redemption or maturity value. Correct or not? What do you think? Yes? Correct. Those who say incorrect? Those who say correct? Those who say incorrect? So this is correct. What do they say is, in the discounts market, funds are raised by issuing bills at a discount. So this happens how? You know, we have two markets, primary market and the secondary market, right? Primary market and the secondary market we have. So primary market is where these securities are traded for the first time. I just drew a picture and show, I think, right? When it comes to the bonds or treasury bills, those are issued by whom? Issued by whom? Issued by, I hear central bank, I hear government. What? Issued by central bank on behalf of the government, right? Securities are being issued by the central bank on behalf of, to meet the funding requirements of the government. That's how it happens. So you have a primary market and a secondary market. This is primary, this is secondary. So when the central bank say we are issuing treasury bills or whatever they are issuing, means they are taking money into them. In respect of that, they are giving some paper giving this is the bond. So cash flow happens this way, right? Cash flow happens this way. They are issuing means they are getting money. So there are people, primary market participants, those are the people who is going and purchasing these securities. 10 banks is there, not every bank, 10 banks, primary dealers. I think First Capital Holdings is there, and likewise there are several primary dealers, not every bank, right? Some bank. So they are the people who is going and purchasing this treasury bill. How do they purchase treasury bills? I mean, giving money or getting money? Giving money. They give money to this central bank and they purchase treasury bills, treasury bonds like this. So in the secondary market means what happens? You and me, we go to the bank and invest in treasury bills and treasury bonds. That is the secondary market. So we trade here, right? We are going and asking for a treasury bond, so the bank gives. But that is being taken from the central bank by the primary dealer, primary market participant. That is a bank. So if I need to trade in the second market, imagine in the secondary market, I am there and you people also are there. I have made an investment for a treasury bill. I need to uplift that and take money. I can trade that due within the secondary market by discounting. Right? By discounting, I will sell my treasury bill and I'll get the money. Understood? Now in a treasury bill, what happens is, I'm investing 95 rupees thinking of getting 100 in the 3 months. So I can sell that at 97. I can sell that at 97, 100 to 97 discounted. I'm selling it at 97. So this person, by retaining that treasury bill for the period, he will earn 3. I already earned 2. All good. You are happy, I'm happy, you also happy, everybody happy. Right? Trading in the secondary market. That's how it happens. Understood now? how the secondary market transactions do happen. Right. So as a result, here you can discount it in the discount market. This is correct. Right? This is correct. So these are like very interesting stuff. Whatever you need, you may note down. Right? I'm sharing my practical stuff. I'm sharing my experiences and everything with related to this financial market, everything. So I don't know for a fact what do you need to write down, nothing. So if you feel like noticing it, you may note down and understand. And if you have any queries, you can ask. Right? Okay. Which three of the following are key roles played by money markets? Quickly select. Key roles. Swiss roles. This is key roles. Money market is, what's the other word? Money market, and what's the other market in comparison? Capital market, right? What's the difference between money market and capital market? Yes? Selling money. Just like fruit market and fish market do. Then, yeah, money market is short term, less than 1 year. Capital markets is more than 1 year. So they are asking about money markets. Providing short term liquidity to the companies, banks and public sector, correct or not? Correct or not? Correct. Providing short term trade finance? Correct. Allowing an organization to manage its exposure to foreign currency risk and interest rate risk. What do you think? What do you think? Those who say correct? Those who say no? Right. Last one, dealing on long term funds. Long term, that is incorrect. As a result, this is correct. Okay. You have long term here, no? Because of the fact it's incorrect. So definitely this is correct. Right? Now ask me how. Allowing an organization to manage its exposure to foreign currency risk and interest rate risk. So both the risks, foreign currency risk and interest rate risk, what do you think? Short term or long term? What do you think? Short term or long term? Interest rate risk and foreign currency risk. Imagine I'm like importing a vehicle from Japan. Theoretically, yeah, I can't do theoretical. Right? So I'm ordering it. I just need to make the payment in at least within a maximum of 1 year. So I'm concerned about my foreign currency exchange rate risk less than money. So I'm importing a vehicle. I'm getting that after 5 years. That won't happen. So this interest rate fluctuations and foreign currency risk fluctuations are short term. Right? So what I can do, the simple thing I can do to hedge, the word is hedge, right? Risk management, hedge. If I have a foreign currency risk, as an importer or as an exporter, I will have a risk. Think I'm an exporter. I'm exporting stuff to Israel. Right? Anyway, you won't get the payment these days. If I'm exporting fish to Israel, there are companies doing that, right? Those are in danger now these days. So maximum, I'm waiting for my payments to come. So they are not paying in rupees no anyway. They are paying in foreign currency. So I have sent an export. They will be paying back in dollars or whatever. So they will make the payment in, let's say, 3 months. Fish should reach Israel for them to pay. Fish means what I'm selling. Right? So after that only they pay. So what my concern is, whether the foreign exchange rate would change and what will happen to me after 3 months. Isn't it? So as an exporter, what's the risk? Yeah, foreign currency, I mean going up or down. As an exporter, think. Exporter, you are here, you are selling fish to Israel, right? Value of the order is 1 million rupees, right? Today the dollar rate is 300, right? So when I send the fish, if the Israel people pay me today, what's the amount I'll be getting? What's the amount I'll be getting? Use your calculator and multiply. 300 million, right? So after 3 months only, I'm getting the payment. 3 months, right? So I'm concerned about the dollar rate getting into 280 or concerned about the dollar rate getting into 320. Which one? If the rate becomes 280, what will happen? My profit margin is gone. Why? They pay me 1 million, they will pay, but when I convert, I'm getting that. So if it goes this way, bonus, right? So this is for export. Importer, if I'm importing fish from Israel, or even you can import dead bodies these days, right? So what will happen? I need to pay. I'm the one paying. I need to pay $1 million. $1 million. If the rate today is 300, I'm paying only 300 million. After 3 months, 280 or 320. You are concerned about the rate becoming 280 or 320. 320. Why? If the rate goes to 320, I will have to make another 20 million of payment. Understood? So in the society, it's so cruel, guys. Society is so cruel. There are two parties waiting for the opposite to happen. Exporters need the exchange rate to go up. Importers need the exchange rate to. Society is cruel, right? Isn't it? Right? People do want opposite things. So understand. To match this, how can I match this? Today I'm going into the bank and agreeing upon an agreement saying, no matter whatever the hell happens, even the World War III, I will pay this at 300. Will you agree or not? That is called what? That is called what? That arrangement. That's the first instrument in risk management and the first instrument in the derivative market, foreign exchange contract. So you can go to the market, go to not to the market, bank, right? Go to the bank and get into an agreement with the bank. Look here, no matter what the rate fluctuation is, can you agree on this? I will make the payment or receive the payment at a fixed exchange rate after 3 months. You can do that. That is how you match that risk. So doing this, agreeing with this bank like this, can you agree for like 5 years? You go into the bank and say, look here now, today the rate is 300 no. I need to get some money from my whatever the person in 2040. Can you agree on a rate today? Longer term, this is a risk to the bank. One party wins, one party fails. Right? So when the bank agrees for 300, what will happen to the bank if this goes in the other way? Risk. So bank will try to reduce the period up to a maximum. So as a result, so I was explaining every this thing for this question, right? You went into another world. Why this importers and exporters? I'm talking about this question. Where is that? This one, which implies short term. Okay. So you are hedging the foreign exchange risk in the short term. That's what I need to say. All right. Okay. You don't want everything. You can select the answer like that. Here long term, rest is correct. Question number 9, quickly. That's simple, I already explained. Tell me the answer. Question number 9, primary and the secondary market. This how to deal with the exchange rates, importers and exporters both I have put here. What's the answer? Question number 9. Question number 9, answer is A, right? So the primary market is where the securities are being issued, and the secondary market, what happens is it's being traded. So both primary and the secondary markets related to where securities are traded, incorrect. Both primary and secondary capital related to sale of new securities, incorrect. Primary markets are where stocks trade. Loan notes are drawn, incorrect. Answer is A. Question number 10. Which of the following are money market instruments? In this type of a question, you know the technique, right? Select one incorrect thing and then look at the options. What's the answer? A, B, C. Yes, it's easy, right? So you can see directly corporate bond, it's not short term, it's capital market. So 2 cannot be there in the answer. This incorrect, this incorrect. Both as 1 and 3, look for 4. Treasury bill, it's a short term money market one. Answer is C. That's how you select. You understood? So corporate bond cannot be. So if the 2 is there, it's incorrect. And 1 and 3 is common. 4, treasury bill should be. Question number 11. Which 3 of the following are true in relation to certificates of deposit? What? Which 3 of the following are true? You don't have to select 3. Just tell me what's the incorrect one. That's enough. That will give you the answer. Tell me which one is incorrect. B. No. So here, straightly you can see not negotiable. This is incorrect. Certificates of deposit gives you instant liquidity. Instant liquidity, right? It's completely negotiable. Those who got the answer as B? Incorrect. B is not the answer, no guys. They are asking who is correct. B is the incorrect one. I selected the incorrect one. So answer is A, C and D. You feel sleep, I feel like. Right? This is not the answer. Come on. Right. So done with that, we'll go to the new part. Right, you may drink some water, you may chit chat a bit. And now focus, right? So the new part, financial system, the second part. Now in a financial system, guys, we learned the financial products, right? Okay. All right. Okay. Yes, more sound. I'm like wondering from where it comes. Are there people in the down also? No. Right. Right now, silence. So financial systems, we understood what are the types of markets, right? Which is there in a financial system. Participants for a financial system, banks, businesses, you and I, government, everyone, right? And then what are the financial products? Certificates of deposit, bonds, right? Treasury bills, everything. Then we calculated the returns also. Okay. Now we are going to some other side. Interest rates, right? When you say interest rates, now, when you say interest rates, what comes to your mind actually? When you say interest rate of a country, what's that interest rate? Loan interest rate for you and I, poor people, right? Then for rich girls, that see fixed deposit interest rates, right? So what are the interest rate? When you say interest rate, what comes to your mind? Interest rate can be the borrowing rate, right? The rate at which I'm going into a bank and taking a loan, and then again the fixed deposit rate. How do these things like interconnect? Haven't you thought of? We have a lot of stuff to think. Right. So it's like this. When you say interest rate, right? There are a lot of interest rates, right? So central bank has standing deposit facility rate, standing lending facility rate, overnight policy rate, market interest rate, banks has loan interest rate, right? Fixed deposit interest rate. It's a mess. So when you say interest rate, there should be a single one, no interest rate. So going up or going down, we are talking about in economics, right? Interest rates going up or down. So what happens to the market? What happens to the market liquidity and everything we are discussing. So when you say interest rate, as a result, there are many rates of interest which reflect varying risk. However, there has always been a central rate around which the others vary and to which governments have paid great attention. This has usually been the rate at which the central bank would lend to the money market, right? You can name several names when you say interest rates, true, but the central rate is, what do you mean by central rate is the rate at which central bank pumps money into the money market. Right? We'll think about it that way. When it comes to the central bank, now haven't you have had this question? We have physical cash, no? We have physical cash. I mean, you have no in hand. So where do these things come from? And when new notes are being printed, how that happens? So somebody prints it and gives it to the people, isn't it? So how does these things happen? Haven't you thought of? How do new notes come into the market? Previously, it was like Sataka man was printing it and printing, giving. That's okay. But the true manner, how should that happen? Banks give. Central bank gives to whom? To other banks. So banks give to this, give to this, and that goes on. They play. How does this money come and how being taken away from the system? And how does new money come? Have you thought of? The problem. How come this? So no more cash, then it comes to the card, ATM card, is it? So there's a mechanism to that. So central bank, that's one of the key mechanisms in the country. Remember, key mechanisms in the country. That is, we have one response. I'm thankful. Up to which lesson do we get for upcoming mock exams? Up until 3:59 p.m. today, 25th June 2025. Up until the last word I'm speaking today, apart from go home, everything will be coming, right? So which is demand, supply, price mechanism, financial system 1, financial system 2. Right? That's what they say. They told me that they will give questions like that. So you will have to face that. I don't know, deal with it. Right? When you take a country, there's something called, now in the financial system, when you take the financial system, the key role is central bank, right? Key role is central bank, and inside that, Mr. Andalal, right? Central bank governor. So there's something called monetary policy of a country. So that is how actually the money supply changes within the country. Central bank holds nearly 6 to 8 monetary policy meetings for an year. And they decide that the monetary policy would behave in this manner or behave in this manner, or what manner he will decide. Basically, it can be an expansionary monetary policy, or else it can be a contractionary monetary policy. If the central bank thinks we should increase the amount of money in people's hands, that is called an expansionary monetary policy. So what can they do? Not that they can't like distribute money. So keep it, no. Using the open market operations as we discussed. Right? If the central bank thinks people should give, we should maintain big amounts of money in people's hands, there are tools they can change, right? Basically, one tool is interest rate. One tool is interest rate. One central interest rate they can change, right? What they can do is, in the monetary policy committee, they decide that we should have an economic boom in the country. Not a bomb, boom. Economic boom, right? So they think we should let people to spend more and more and likewise. For that, think and tell we mean central bank governor should reduce the interest rates or increase interest rates. Reduce. What will happen? Then okay, accepted, then nothing happens. Central bank prints and give, we wait. No. Central bank will say they have two policy rates like SDFR and SLFR, that is standing deposit facility rate and standing lending facility rate, that's separate thing. Think of an interest rate, whatever the interest rate. If they reduce the interest rate, what will happen? Simply, I'm developing several arguments in the opposite manner also with the questions. If they reduce the interest rates, people will start to think, now these buggers are reducing interest notes. See, previously we had 20% for the fixed deposits. Now we have 8% for the fixed deposits. No point. No point getting 8% for the fixed deposits. Now, when the interest is being accumulated, for that also a tax is there, right? Withholding tax. So the return is really less. So rather than investing in banks, now rather than putting fixed deposits and everything, we shall chill. We shall have some parties. We shall purchase. If you have one vehicle, you are purchasing two vehicles, right? Purchasing. So economic activity would increase. Listen to this story, right? Do I have time? Yes. So when interest rates are brought down, people will be discouraged to go for savings. People will not go for savings. No point in savings. Why don't we eat, drink, chill, purchase, whatever, anything? So in that manner, whatever the money which was there inside the banking system will come into the market. People will uplift the fixed deposits, no point. And they will start up spending and spending and spending. So demand for the goods and services, what will happen? Demand for the goods and services increase. As a result, to have the equilibrium, what will have to be happen to the supply? Decrease? Increase. Demand increases for goods and services. Supply also needs to be increased. So whatever the companies or the industries manufacturing goods and services, they need to speed up and they need to increase production. They can also do that. Why? Interest rates are low. They can simply, if they need additional funding, it's easy for them. They can go to the banks and take a loan at 5%. Again, increase and increase and increase the supply. More goods and services coming into the market, more people purchasing. Country is running really well. Can that sustain? Can that sustain? Why? World is so cruel. Then, if it continues to be like that, if that continues to be, so everybody demands, supply, demands, supply. Yes. So in the next monetary policy committee meeting, so now we had the economic activity, right? Now the companies are doing really well, people have money. Next monetary policy meeting, the central bank would decide we should reduce this a bit. So what they will do, they will raise interest rates a bit. Now what will happen? Now what will happen? People will start now. They are paying really well, no? Last month they paid 8% for the fixed deposits. Now it's 16. So why don't we have to purchase anything? So why can't we go to the bank, put a fixed deposit, take the interest and wait at home watching TV? Right? So the people's spending will but reduce. The arrow is this way, but the reduce, right? It's like a small elephant and a, right, likewise. You can say small elephant like this, right? Small elephant. It's incorrect. Like that, although the arrow is there, what will happen to the demand? Decrease. When the demand decrease and the rates are high, people will go for more and more fixed deposits. What will happen to the money? Again, going back into the banking system. Right? Industries, they can't borrow because the rates are getting high and high. And also on the other hand, the demand is getting down. So they can reduce the supply as well. So this is the equilibrium which is there in a country. This is monetary policy. So what's the instrument which is there for the central bank to control it? Interest rate. Understood how this happens? Clear enough? Right. Okay, have some tea and come. We'll discuss the next part of this is monetary policy. Right? This is monetary policy. You can have your break and come. I'll discuss the next part afterwards. Okay? Go downstairs, then again come. 20 minutes go. Okay. Right. Can we start? Okay. Half is not there. Right. So my story about the monetary policy. Okay. So the deciding factor or the instrument the central bank has to control the monetary policy, or how do they give the message to the market, what needs to be done is through the interest rate. Right. So when it comes to the interest rate, there are some just like the interest rate, there are three things which link to the interest rate. Another two rates that is called the triplet of basic triplet of economics or something I can't remember. Three linked. One is interest rate, the other one is inflation rate, the other one is exchange rate. So in the broader picture, when I say in the broader picture, when like carrying on the central bank function of the monetary policy, all these things plays a role. Although interest rate is the key factor, exchange rate. So how does interest rate and the inflation rate link? Interest rate and the inflation rate. Basically, what is inflation rate first? Okay. Inflation rate, rising prices. Is it? Percentage by which the general price levels increase is known as inflation. So the link between this interest rate and inflation rate is like this. Exchange rate is something else. You know what exchange rate is, right? I showed previously how exchange rates changes, and for the importers and exporters, how that matters. Imagine you go into the bank and you make an investment for a fixed deposit. So what comes into play is interest rate, right? The bank will say, I'll give you 10%. That 10% interest, if you calculate using the basic present value equation, you can get the amount of interest which you can earn after a particular period. If V is equal to PV into 1 plus R N, you know that equation, right? Hopefully you know. You don't know. You don't know. Present value equation? No. That was there in grade 5. No. When we were doing future value is equal to present value is in present value into 1 plus R is into N. This. Now you know. Now you know. That was there for scholarship, no? Right? Okay. So if you like go and invest like 1 million rupees, you know the present value, you know the rate is 10%, you know you are investing for 1 year, you can calculate the future value of your investment, and accordingly the difference between future value and the present value, we can get to know what's the interest you are earning. Imagine for a 1 million rupee fixed deposit investment, 1 million, let's imagine you earned 100,000. Right? You earn 100,000 as interest. So what will you do with that 100,000? What will you do with that 100,000? Eat, drink, reinvest. But you can do a lot of stuff, right? If you have 100,000, give me, I'll show you what you can do. Right? If you have 100,000, I'll show you what you can do with 100,000 if you have, so give me. You can do anything with this 100,000, right? If inflation was not there. But for our, whatever the reason, inflation is there. Right? Now, this is like a story now, remember, right? This is like a story, remember. You going into the bank and investing 1 million rupees. After 1 year, you are getting 100,000 as interest. So we could have done a lot of things. I mean, lot of things using this 100,000 after 1 year if inflation is not there. But for whatever our this thing, inflation is there, which is rising price levels. The link in between these two is, if the rising price levels is not there, I can go to the supermarket and buy 100,000 worth of goods and stuff, definitely. But from this, now if this is the year, here you are investing, here only you are getting 100,000 this interest. Okay. So whatever the goods and products you could have purchased here at this point for 100,000, can you purchase the same here after 1 year? Why? Culprit is inflation. In any country, there's inflation, right? In any country, which is price levels do increase. Think of a laptop computer or something, which you purchased 5 years back. Can you purchase the same? Now, it's a different model, I mean. So, can you purchase a general category of a laptop today at the same price? Right? So, increasing levels of prices. Because of that, although I receive 100,000 as a return here, its real worth, real value, is it 100,000? Nominally, right? Nominally, you earn 100,000 at the end of the year, true. So, here 1 million, simple calculation, you earn 100,000 there. But the amount of goods you could have purchased at this point, you cannot purchase at this point, which is simply the real value of this has fallen. Understood? Whatever the amount you can purchase after 1 year is not the exact. So, in that sense, have we realized the real interest rate of 10%? Have we realized the real interest rate? Or is it less? Is it less? It's less. Right? So, in that manner, is there a connection in between the return we get, interest rate, and the inflation rate? Yes. Yes. So, that's what our first part is. Now, I explained you the entire background, right? Monetary policy and everything. So, you should understand this. Real and nominal interest rate, the interest rate can be broken down. Real interest rate, the interest rate adjusted for inflation, showing the actual gain or loss in purchasing power. So if we have adjusted now, if the bank says, no, your actual return would be like 9% or 8.5%, if that is adjusted for inflation, we call it real interest rate, then that's good. But without adjusting, the people might say 15% interest we are giving. So everybody goes into that bank and invests 15%. What has happened? Not adjusted for inflation. If that is adjusted for inflation, you are not receiving actually that much. So real interest rate, the interest rate adjusted for inflation, adjusted for inflation, showing the actual gain. Nominal or money interest rate, the stated interest rate on a loan or investment before accounting for inflation. Inflation rate is how fast the prices of goods are rising. Right? So, there's something called Fisher's equation which links 3. This is this. Suppose inflation is 3% and you deposit 100 in a deposit account paying 4% per annum. Nominal, the same one example I did explain. Right? So, this is the equation which you need to remember. This is the equation which you need to remember. That's the relationship between real interest rate, money interest rate, and inflation. Right? So, interest rate can be inflation adjusted or not. If inflation adjusted, real interest rate, not adjusted, money interest rate or nominal. This is the simple example, simple equation you need to have to remember. Okay? Right. Then they have shown like the calculation for the example. When the nominal rate of interest is higher than the rate of inflation, there is a positive real rate. This means that the borrowers are losing in real terms, but savers are gaining. What do you mean by that? When the nominal rate of interest, when the nominal means what? Inflation not adjusted, right? When the nominal rate of inflation is higher, when the nominal interest rate is higher than the rate of inflation, right? We'll take for an example, nominal rate is, we'll take nominal interest rate is 10%, which is not inflation adjusted. And the inflation rate of inflation is 8%. Positive real rate, this means that borrowers are losing and the savers are gaining. So in my example, in my 1 million example, which I took, interest rate was 10%. Imagine interest rate is 10%. So I got 100,000 as 100,000 as what? The interest. So if the inflation rate is 4%, inflation rate is 4%, it's approximately like I'm getting 6% interest on this, because like interest I'm receiving, but for inflation I'll have to match. So that's what here they mention. If the nominal rate of interest before adjusting rate is high than the rate of inflation, savers are gaining, right? Those who go to the bank and saving, they will have a gain. By inflation rate is less, nominally you are getting a higher rate. When the rate of inflation exceeds the nominal rate of inflation, there's a negative real rate of interest, borrowers gain. So imagine fixed deposits, they agree to give 8% interest, but the inflation in the country is 20%. Inflation in the country is 20%. Fixed deposits, you are receiving 8%. No point. So in that sense, those who are going into the bank and borrowing, it's good for them. Why? It's a lower rate. They are borrowing at a lower rate, even inflation is high. So if the mismatch, if the rate of inflation exceeds nominal rate, borrowers will be gaining. Clear enough? Right. We'll do a few questions to understand the relationship between these three. So question number 1 and 2. Use the equation, real interest rate, nominal interest rate, and inflation rate, and get the answer. Those who are joining online, you can put the answer in the chat box. It's so practical, guys. So sometimes the companies do, if you are like employed, the companies might enhance your salaries, not proportional to the inflation rate adjustment. If that happens, there's no point. Imagine you are working and your salary goes from 100,000 to 110,000. But inflation rate of the country is at 12%. So although you get an increase of 10%, which is 10,000, to get the same amount of goods and services which you purchased previously, now you need 12,000. So your increment is 10,000. You need 12,000 to buy the same amount of goods. So is it worth it? No. Right? So if the increment is 20% and your salary increases by 20,000 and the inflation rate is maintained at 4%, then okay. Clear? And the next question I need to ask, a country should maintain an inflation rate or not? What do you think? Why? What's your opinion? A country should maintain an inflation rate or not? Why? Yes? What do you think? Why do you say so? Yeah, inflation rate should be there or no? Reason? No, not sure. You? Why? Yes, yes. Inflation rate, whether it should be there or not. What do you think? Should be. Why? You are from Gota's government. Should be. Why? Yes, definitely. So if you have an opinion, no. So if there's no any inflation rate, right? As correctly said by one student, correct, there will not be any kind of an incentive for the producers and the people and the consumers as well. So every country, so for Sri Lanka now for these days, there's a inflation target to be matched. Every country has an inflation target, which is they should maintain inflation at this range. It's I think 5% for the country these days, right? You should maintain inflation at that rate. So you can't say that if we love a country where there's no inflation. So you purchase some of the goods today, same price. 20 years after you purchase, same price. No point. So the supplier demand equilibrium for the consumers and the producers, right, will not be there if inflation is not. So inflation should be there, but at a particular range. Okay. Right. Question number 1. Who's this Daniel? Whoever. How does the money printing work? I'll answer. Have to maintain the inflation rate. Yes, Vidusha. Correct. So Daniela has received a salary increase from pounds 30,000 to 36,000. Congratulations. Given inflation for the next year is expected to be 5%, what is the percentage increase in salary Daniela received in real terms? Companies can do that, right? Without matching it to the real terms or without matching it to the inflation, you can say we have increased this much of salary. No point. So salary increases from 30,000 to 36,000. Inflation given expected to be 5. What is the percentage increase in salary? So now our equation is this, where I can write. What's our equation? What's our equation? 1 plus R 1 plus me, mi, 1 plus me, right? You know inflation rate, I'll help. That, of course, I'll help. Inflation rate, you know, what's it? 5%. So 1.05 is the denominator. To get this, how do you get the money rate? Money rate, how can you get? They only say the expected inflation is 5%, but they are asking about the real, this. You can understand that, no? That they are asking about this. That itself is a question, no? Right. You can understand this. You don't know this, but they say salaries increase from 30,000 to 36,000. So percentage change, how can you calculate? Percentage change, we did somewhere, remember? Final minus initial divided by initial, I told you. So take that. 36 divided by minus 30 divided by 30. What's the percentage you are getting? 20%. Right. So here it's 1.20. So you will be getting 1.143. Is that the answer? Is that the answer? Not really. 1.143 is what? 1 plus R is equal to 1.143. R is equal to 0.143. So R as a percentage is 2 decimal points, 14.3. Percentage, 100 has 2 zeros. So 2 zeros. Okay, 14.3. Those who got that answer? Perfect. Right? So one part of the economy can see, some part of the economy has taken the answer. Right? So there's equilibrium. There's no equilibrium. Others should try to match the equilibrium. Okay, economic terms. Some part of the economy can see, one part of the economy has taken the answer for that question. So it's an incentive for that part that you should match that equilibrium. Right? Question number 2. Question number 2. Quickly, lot to discuss. AUSL is considering an investment within the year. Within the year, they are concerned about interest rate volatility. Which of the following are the likely consequences of a fall in interest rates? This fall in interest rates. Quickly, I'll give half a minute. Those who say it's A, B, C, D. Why? You need more time. Okay, do. If the interest rates are taken downwards, very important point there. So if the government reduces the interest rates, what I originally explained here, what will happen? Government reduces interest rates. People will start up spending and spending and spending, right? So the demand increases, supply increases until it reaches equilibrium. Similarly, out of these 4 options, a rise in demand for the consumer goods, is it correct or not? What will happen? Rise in the demand for consumer goods. Yes or no? Yes. Fall in investment? You see? Okay. I said yes, so I'll keep it for a while. A rise in government spending. A rise in government spending. A rise in government spending excluding interest on government debt. Actually, does that happen? So their motive is to increase the liquidity in the market. So what they need is they are bringing down the interest rate. So whoever the people who have invested in bank fixed deposits uplifts and bring money to the market. Just like that, can't the government also spend? Government also can spend. Right? Government also can purchase, like let's say whatever the investments where they are, like if there are corporate debentures, just like the treasury bonds, if there are corporate debentures, so the government can go and invest in John Keels, they can invest in Haley's. So the government spending also can happen. Why interest rates are less? A rise in the demand for housing can happen. Can happen. Yes. Anyway, demand, these two correct. So rise in government spending is also correct. A fall in investment not always happen. Right? Especially being Sri Lankans. We are so innovative to find out ways in which we can do frauds and stuff and where we can earn more return. So if the borrowing rates are really less, right? If the borrowing rates are really less, can't you do something like that? You go to bank A, right? You give your salary particulars and everything. You borrow. So interest rates are low means the borrowing rates low. Why the just industries just borrowed? When the interest rates go down at certain point, sometimes there will be an inequilibrium. Why? People will go and borrow because borrowing is cheaper. Borrowing is cheaper, and then they will take that money to some informal stuff and they will go and invest to earn a return. Can't they do that? Bank A borrowed, taken into bank B or C, invested at a rate. Can't they do that? Remember. So as a result, all the time, a fall in interest rate will not result in a fall in investment. Understood now? We'll write. Put a star mark somewhere like here, several points downwards, you'll have to write. Government debt becoming cheaper. Government debt becoming cheaper. Expenditure of debt interest goes down. Expenditure of debt interest goes down. Borrowing becomes cheaper. Government might borrow more. Two star marks and write. Fall in interest rates. Fall in interest rates sometimes encourages investment rather than discourage. Within brackets, borrowing at a cheaper rate to invest. Borrowing at a cheaper rate to invest. Originally, what happens is what? When the interest rates are brought down, investments goes down. But until one point only. At that point, people will start up borrowing and then investing. That's why we have 6 to 8 short-term monetary policy meetings and we are quickly changing. All the time we can't keep the same thing. Right? Okay. So question number 3, we'll do it at the end. Right? You just write at home and come, I'll explain the rest of the theory part. Right? Question number 3, do come to the class doing it. Right. Financial intermediaries. So this we have discussed already. I'll have to speed up. So financial intermediation and intermediaries, did we discuss? Financial intermediation process. Why financial intermediation is required? Yes, because to match the risk and to also to match the maturity transformation, we need financial intermediation. So financial intermediaries are of two types: deposit taking institutions and non-deposit taking institutions. So deposit taking institutions, banks, and what are building societies, guys? So remember, although you are living in Sri Lanka, you are following a UK qualification. So we are teaching UK stuff. You are living in the country, but right, building societies is in UK. So it's a deposit taking institution, right? Remember. So insurance companies, pension funds, unit trust and investment trust, those are non-deposit taking. In our country, what are the deposit taking institutions? Yes, all banks, not all banks, commercial banks, not the one with the logo, but commercial means every bank, right? But there are some banks which does not, right? It can be investment bank. So NDB has an investment arm. So they are into financial advisory and likewise. So non-deposit taking, there are, right? EPF, ETF, pension funds, all these are non-deposit. So they can't accept deposits. So the distinction is made for three reasons. The deposit liabilities of DTIs, like deposit taking institutions, from the bulk of the country's money supply, DTIs are more important to government economic policy and hence central bank attention, which is when there are two types of banks like deposit taking and not taking. So in the central bank's function of monetary policy, they need to focus more on these deposit taking banks because people's money they come and store. It's a game in between the central bank and the banking system actually to match the money supply and the liquidity. So when the central bank needs an economic boom, they will reduce the interest rates. So everything in the banking system, money comes into the market. So if they needs to clear up that liquidity, they will increase the interest rates. So everybody will go and put fixed deposits and will not spend. That happened previously, right? Even the banks did that. So financial intermediation, when the COVID came, what happened? You know, COVID, you were there. When COVID came? You are after 2000. Right. So when COVID came, the banks intermediation model actually changed when COVID came, right? So banks original model is taking deposits, giving loans. So when COVID came, did people went and deposit every money? No, money is not coming. And then can we go and lend? Can the banks go and give loans to people? No. So from whatever the money which was there in the accounts, banks also went and invested in treasury bills and bonds. That's what they did. Right? Similarly, this market liquidity, when the COVID came, entire market was liquidity was brought down. Why? Everybody was like the country was locked down, people can't spend. You can walk and go into the bar or club or do anything. No? When COVID came, no spending. Monetary policy changed, right? So in the central bank's function, it's more important for them to be really focused about deposit taking institutions. They have a lot of regulations for that, right? Unlike for the other people. So DTIs are subjected to more regulation. The level customers deposits is more discretionary than other product. Once an insurance contract is entered into, customer is committed to making monthly payments. True. When you take banks and building societies, if you have money, you can put. If you want, you can withdraw using the ATM cards or online or whatever. But when you agree with the insurance company about an investment plan or an insurance payment, as a must, you need to make that payment up until the day. right? So that's the difference. Those are the three different distinctions in between deposit taking and non-deposit taking institutions. Financial intermediation. Clear? Banks. The main business of banks include offering financial services, taking deposits, extending credit. In the UK, their activities are regulated by the Financial Conduct Authority. Don't ask me what that is. Even I don't know. Right? I don't know. I mean, I'm also living in the country of Sri Lanka. I haven't been to. Right? So in UK, this is what the regulatory body. In our country, it's the central bank. So banking activities are traditionally split between the following. Now see, look at this diagram. Right? Banking can be divided into two as commercial banking and investment banking. That's what I say. Now when it comes to the International Bank, it has two parts. HNB and HNB Investment Bank. NDB Investment Bank. Right? I don't know about the others. So commercial banking, what's the purpose? Traditional banking activities, taking deposits, extending credit. That's what banks do. Taking deposits, giving out loans. So in that sense, as a financial intermediary, they are pooling, aggregating, reducing risk, and they are transforming the maturities as well. Did we discuss the four functions of intermediaries? Yes, right? Investment banking, what do they do? Investment bank. Financial market activities, advice on mergers and acquisitions, underwriting new issues. So, just like, unlike the traditional banking mechanism, think if you are a company, you need to be listed in the, you're thinking of being listed at the Colombo Stock Exchange, share market. So you can't do that alone, right? That's a huge process. You have to come up with that process is known as initial public offering or else flotation. For the first time, your shares are being traded at the Colombo Stock Exchange. Right? See that particular uncle is, there's a bill for the first time it's being ring. Then say Colombo Stock Exchange, it's open for trading. That's how it happens. So you have to come up with a prospectus. You have to decide on the share price. You have to decide on the shareholders. Huge process. So there are specific banks which is there, which helps in that function. If you are going for a share issue, if you are going for initial public offering, likewise. And also huge mergers and acquisitions. What's a merger and acquisition? Difference? Yeah. Yes. Mergers and acquisitions. So merger means A company joins hands with B company and make a new company, that's AB company. That's a merger. Acquisition means a company having the same own name can acquire some another company and take that into their country. That is acquisition. So these things are complex financial market activities. So these banks, specialized investment banks, these people help in those factors. The other banks, they just like take deposits, give loans, take deposits, give loans like this. In that as well, there are two aspects, retail banking and wholesale bank, right? So retail banking means high volume of low value transactions. You and I going and depositing 100 rupees, right? So to deposit 100 rupees, you have to write that slip, no, deposit slip. Even that is like 20 rupees. We are filling that to deposit 100 rupees. Can happen. We are poor people. So those type of transactions, low value transactions, high volume, right? Retail bank. Understood? Customers are individuals and small companies, just like my cupcake business, small company. Wholesale banking, low volume, high value. Commercial bank giving a loan to John Kales worth of 50 billion. High value, low volume. Retail means low value, high volume. Understood? Customers are large companies. So they have two arms when it comes to a commercial bank, and again you have investment banks. Main activities or retail or commercial banks. Safeguarding money. I think I should not tell, right? So safeguarding money is their main function. So there are countries in the world where if you go and deposit money, now what we are used to is if we go and deposit money in the bank, they should definitely pay us interest. No? There are some countries, I don't know what, but Google and see, some countries, you just need to pay interest to keep that money. Right? So that's why safeguarding money is a core function of commercial or retail banks. Customers' deposits are kept in deposit time and current accounts. Deposit and what are time accounts? Time accounts? What do you mean by time? Time account? Time accounts? Time means fixed deposits, right? Time deposits means fixed deposits. Current accounts is the accounts for which you get checkbooks. Now you can deal with checkbooks. Receive interest for storing their money at the bank account. Current accounts do not usually gain interest. So remember, the savings accounts give interest a very low rate, nearly 2%. Fixed deposits, a high interest rate, something like 8 to 10%. But current accounts, no interest. That's entirely for the business transactions where you will be getting a checkbook as well. No interest there for the current accounts. Second function, transferring money. Banks move cash in between their branches and also in banks. Nowadays, from local banks to foreign banks, transfer money. Banks can do that. So if I give an order to transfer from one account to one of the accounts in Jaffna, you can. Then one of the accounts to other banks, you can. To foreign banks, you can. There are limitations. Right? Everything is like explained, but conditions apply. Like that. Because like when you are transferring into from one bank to another local bank, there are limits. Right? To a foreign bank, you can't like transfer that. So you can't say, I have my uncle in Australia, you just transfer like 100,000 today. You can't do that. Right? Money moving out of the country, you need to give proof documents and stuff. So the introduction of electronic banking, which is like nowadays you find now digital apps. Using your fingertips, using your phones, you can transfer anywhere, anything within the country. Right? So that is electronic banking. Then lending money, don't want to explain. Facilitating trade. What is that function? Now banks do safeguard money, deposit money, lend money. Facilitating trade means how? Any example? Yeah. So think I need to import something from China or something from Japan. So can I send money to that person directly? Whoever the person selling me the vehicle, can I send that directly, that money? So those are trade transactions. Sometimes we will be sending, like we are a major country who is like exporting apparel to foreign countries. So we will be like exporting these apparel and we will be like getting the money after like 3 months. Right? So if I am sending my stock of apparel to some other country, imagine UK or somewhere, I'll have to wait for 3 months waiting whether I will be receiving my payment. I don't know. But if I go to a local bank and say, why don't you involve and ask one of your friend banks in UK to involve as well and get the help of these two banks in the two countries to facilitate my trade transaction, I have more security. That arrangement is known as letter of credit. Right? So I can involve my bank in the country, Sri Lanka. They will have correspondent banks in other countries. So they will also involve, and in that country, that person who is requesting apparel will pay to that bank. He will send me the money through commercial bank. So that arrangement is known as letter of credit. So ultimately, banks helps in facilitating trade transactions as well. Clear? Other development and advisory services for small firms. Definitely yes. So if you go into the bank or a small firm, if a small business, imagine it's development credit or something, agriculture credit or microfinance, right? What is microfinance mean? Micro vehicle company. Microbes. Microfinance means. So you like think now there's no point in like going for these SEMA classes, no point. You will have several sewing machines and get few other girls also and start up a small garment. Can do, right? Small garment. So that's a small company. So you can go to the bank manager and ask, so this is my new business. I have like fed up with learning. So I have started a new garments business. So how can I? So the bank manager will say, look here, prepare financials like this, open up accounts like this, we will give you loans, right? Then pay the loans to us. That's something else, right? So give advice, financial advisor. So again, repeat, what are the functions of a commercial bank? Basically, lending is not the first one. Safeguarding money, transferring money, then lending money, right? Then facilitating trade and other advisory services and stuff. That is commercial bank. Wholesale banking. These are also known as investment or secondary banks. The most common these banks are merchant banks. JP Morgan. Who is JP Morgan, guys? JP Morgan? Ian Morgan, you know, right? England cricketer. He's JP Morgan means what? Who said it? Yes? American investor. Who else? JP Morgan? Right. JP Morgan is one of the leading banks in US. It's a bank. JP Morgan Chase. Right? You can Google it and see. Now tell me, out of the largest banks in terms of like assets, what do you think is the largest bank in the world? Our central bank. Largest one. Huge building. Largest banks. What are the banks in US? Better kill me. Banks in US. One is JP Morgan Chase. Other one? Banks in US. My God, if some younger sister or brother comes and ask, say blood bank, right? So remember, there are leading banks in the world, right? So when it comes to US, it's Bank of America, JP Morgan Chase, Wells Fargo America, right? UK, our motherland. I mean, in terms of our SEMA, this thing. HSBC UK, right? HSBC is the largest, I think, right? But out of the world, remember, right? When considering the entire planet, if you categorize the largest 10 banks, first 5 is Chinese. Will you believe? In terms of assets, China Construction Bank, Bank of China, then you have merchant something. Anyway, first 5 is Chinese. All right, this is economics, that's what I'm saying. So UK, those are the banks, and US, only 4. Industrial commercial bankers. So JP Morgan Chase is there. Fargo is there, Bank of America is there. I think HSBC UK is not there, no? 7, right. So see what China has done, right? And in terms of the US dollar reserves, right? The global currency is US dollars. So global currency reserves, majority is with those banks, Chinese banks, right? So that is financial system and information you need to know. That's why, so even though Trump needs to put tariffs and everything on China, they can't help it, right? Majority of the dollars are in China. Okay, right. Information for you to know. Find more about that and learn. Overseas banks operating in countries other than their home country. So we have two major international banks in the country. What are those? Two major international banks. HSBC is there, but I think no branch operations, no? And Standard Chartered, right? So those are global banks. Merchant banks, wholesalers of money in the system, banking brokers who bring together the lenders and borrowers of large sums of money, for example, businesses. So what do you mean by merchant banks, right? Entirely into trade, merchant banks, not like wholesale banking. Now, previously Standard Chartered was having operations in the country. 2 months back, I think they stopped it. No more operations, only for the institutional this thing. So institutions only, businesses can do. So likewise, banks do take decisions, right? So merchant banks operate in high risk area and deal in very large deposits and loans, primarily from industry and commerce. They often borrow from each other, advise companies on money management, negotiate bills of exchange, underwrite. So this is one kind of a bank, merchant bank, right? Sri Lanka, here also we have, no? Merchant Bank of Sri Lanka, we have one arm. That's not international. So what do merchant banks do? They primarily lend into large companies. They are not into like taking deposits and lending to you and me. So they lend into these kinds of large companies, merchant banks. And also they facilitate these other kinds of advisory services, bills negotiating and likewise. Clear? Next part, overseas banks. Not required. So we were discussing about banks, right? So although banks is there now, why are we discussing about banks this much? What's the purpose? When it comes to a financial system, who plays the major role? Banks. That's why, yeah. So non-banking financial intermediaries. What do you mean by non-banking financial intermediaries? Non-banking. They are not doing the basic banking function of taking money and lending out, but the other banking functions they are following. So these institutions are not officially authorized by the Bank of England, although they are informally watched. The best known type of non-bank in the United Kingdom is the building society. See, I told, right? So building societies, when it comes to the Sri Lankan context, you might feel some sort of a construction company. No, this is not, right? So this is what you find. So I have included the considerable information about that. right? Just have an understanding, because you will not be tested about what's a building society and all. Get to know that there are like banking institutions and non-banking financial institutions as well. One such is that. What do you mean by investment and unit trusts? Have you heard of unit trusts? Heard of? What's the purpose? What's a unit trust? Can be pooling money. So accept savings by selling shares and invest these in savings mainly in companies. So now we are like discussing about the complex financial market, right? So the problem is we don't have money. So if we have money, there are like a lot of things to do. So one such is unit trusts, right? Unit trusts, what they do is, if that's a unit trust, you may give money to that person. That person in return will give you money. In return will give you shares of a company. See, accept savings by selling shares or units. That's why it's called a unit trust. So now giving money, I have some kind of shares. So then that person, that unit trust is having a considerable amount of money. That amount of money, they will go and invest somewhere. Treasury bills, bonds or whatever, and then earn a return. From that return, they will pass that return to us using dividends, capital gains, likewise. That's a unit trust. Then pension funds. What do you mean by pension funds? Now, if you are working for a company, imagine 5,000 employees are there in the company. For everybody, there's a pension, imagine. There should be a pension fund accumulated. So if I leave today, I will have to have my pension with me. So where's this fund located? So imagine a company having 5,000 employees. So when you get the salary, from the salary, a considerable portion is being deducted as EPF or ETF. That is our pension fund. So the deducted amount of money accumulated from 5,000 employees is there with the company. So what do the company will do? Company will go and invest that in a bank or bond or whatever. So that is what we call a pension fund. By investing, they may get additional returns. Clear? So accepting savings from their customers, both individuals and companies, normally on an ongoing basis, to invest and provide retirement pensions for their customers. So again, now everybody of the company is not living on the same day. So when you are leaving, you have a build up pension fund to match that pension requirement as a bulk, right? Then insurance companies. What's the business of insurance? What happens? What do insurance companies sell? What? What do insurance companies sell? Anybody from an insurance company? No? Oh, and work in insurance company. What's the business of an insurance? They're selling what? They're playing with what? Yeah, they are getting a risk, but talk to insurance agent one day. Go and talk. If you talk to an insurance agent, you will get to know how many methods are there on this earth for us to die. He will nicely explain. So if you die like this, we will give this much to your family and children and like. So you can also die like this, right? Right? Sleeping you can die. Walking you can die. That's the insurance business. They are selling our fear of dying. Simply. And if vehicle insurance, what do they? My God, sir, there are a lot of vehicles on this country. So don't take the vehicle into the road. Right? If you have a vehicle, keep it inside. Don't go anywhere. That's what they say. Isn't it? So insurance companies, what do they sell? Risk transfer. So if I'm having a vehicle, if I'm getting a vehicle insurance, I'm driving like nothing. That's okay. Let anybody die. Apart from me, I'm okay with it, right? If something gets crashed, I'm okay because the risk I have transferred to the insurance company. If I get crashed with something, I will immediately call the insurance company, get my vehicle sorted. I will not pay. So they will like take my vehicle, they will like put that in the garage and do their thing. So the risk when I'm driving, not me, everybody, right? You smiling, right? Right. So when somebody drives, the risk of meeting with an accident is being transferred into the insurance company. That is the insurance company. To that, what do we do? To have that peace of mind, as he said very correctly. They are selling the fear. No, so you can die like this. You can have this number of diseases at this age. My God, you are surviving. How good, right? You should definitely check on that. You will have these diseases, cancer, every type you might have. So why don't you have an insurance? Right, try it. Talk to insurance agent one day, right? So they are selling that. So for that we are paying a premium for the vehicle insurances. Given a year, not every vehicle meets with an accident, right? But every vehicle pays a premium. Every vehicle having a vehicle insurance will pay a premium. Let's say everybody takes a vehicle insurance. Everybody pays 100,000 rupees to the insurance company for the year 2025. But only 5 of us meet with accidents. Getting lot of money, paying little amount of claims. So money being accumulated in insurance companies, isn't it? So what will they do with that? They will do charity. They will give to temples and churches. Do you think? No. They will invest. So they will invest and multiply their return. So if somebody quotes an accident, is that okay? Okay. You go for an accident, we will pay. We will come there and pay. Right? If you want, we will take the vehicle, we'll repair and give. Insurance business, good or bad? Really good, highly profitable. Right? Now don't go and join insurance company, they won't pay you. I mean the business as a whole. Finance companies, the next one. What are the finance companies you know in the country? Finance companies? Don't know? What? PLC. Okay. People's leasing. Okay. Yeah. How many number of finance companies do we have? LB Finance, Asset Line Leasing and Finance, People's Leasing. How many? So what's the business? What's the business? Finance companies? Come on. This is guys. Finance companies. What's the business? Now insurance companies, you know, unit trust, you know, pension funds, you know. Finance companies, why? Why are you going for a finance company? What's the purpose of finance? Why LB Finance is there? Why? Think. Yeah. Oh, you have to meet, you mean, trust me, every need in your financial market, you have banks. You say banks will do anything. But why finance companies then? You don't want. Yes. No. So in terms of facilitation to the general public. You try out going for a lease, ask it from a bank and ask it from a finance company. Lease, you need to buy a vehicle. Lease facility. Go to a bank and ask. Go to a finance company and ask. Finance companies, when you step into the finance company, documents are ready, sign it, take the lease and the vehicle and go. When you step into, okay, for a vehicle loan, like done, sign. But banks, will they give? I told you, right? They need grandma's birth certificate as well. Banks. But leasing companies and finance companies, but is it worth? When you start to earn and when you get the first salary, you are going to a finance company. It's easy, no man. Fine, go. Will you go? Don't ever go. Why? They are, yes, definitely. They are assuming high risk. Finance companies take high risk. When high risk, high interest rate. So if we can go for a lease in a bank at 12%, they will give at 30%. But fast. No security, no documentation, no anything they will give. But at higher rates, facilitating, fine. If you don't pay, your smile says the story. If you don't pay, that is the end of the story. Right? So today installment, if you don't pay, the next day you don't have the vehicle with you. Because they are keeping a key, right? If a vehicle has 2 keys, they are keeping a key with them. So you end up not paying, you come to the garden and see vehicle is not there. Right? So they are giving higher rates. Why? To match high risk. They are taking high risk. But for the poor people or whoever, you can go and take. Now, can you like go into a bank and ask, I need to purchase a motor bicycle and I need a lease? Will a bank give? Will kick you. Right? Banks won't lend to that small range. Right? That's how the business is. So they will give to only 4-wheeled vehicles. So for every requirement, you can go. Okay? Understood the difference between unit trust, pension funds, insurance companies and finance companies? Talk to insurance agent, right? Select a girl. So will be explained now. If a guy explain like this, right? Credit creation. This is important. So what do you mean by credit creation and credit multiplier? For every deposit made, the bank keeps some in reserve but lends out the rest to borrowers or others users of cash. The amount kept by the bank is known as the cash ratio and is expressed as a percentage of deposited funds. I'll explain, but read first. The rest of the money can be used by the bank to earn money. So if the cash ratio is 5%, then the bank can lend out the remaining 95% of money deposited. It charges interest on this money lent out. It's like this. So, depositors coming, right? Think of a bank. How do they create credit? Now, when a bank is there, people do come and deposit money, right? People do come and deposit money. Imagine if 100 is being deposited dollars, right? Right? 100 being deposited. Banks business is to take these deposits and to lend out. That's their business. So you have 100 deposits received. So can you like lend out? You think of giving out loans, 100. That's my boy, that's business. 100 taken, 100 lent. We keep the margin. Can the banks do that? What do you think? Can the banks do? Why? Speak. That's okay. Yeah? Yeah. Can the banks do this? Yes? No. There's that's what I'm saying. So even though the banks receive this amount, $100, anywhere on this planet, banks can't lend out that 100. That can't be done. Right? There's a small portion which needs to be deposited with the regulator or which needs to be kept with the bank. Right? That is, in local terms, we call it statutory reserve ratio, SRR. That is 2% in the country right now. In our terms, it's called cash ratio. So what will we do? We will like keep $5 with grandma, like saving, right? $5. And then we can lend out $95. We only lent out $95. Why do we keep this? Why can't we go and lend everything? Why do you think? We can't lend everything, no? So that's better. We can earn more profits. No, that's not the case. We are lending out this depositors' money. This is depositors' money. Is it? Depositors' money. So we should keep some kind of an buffer to match the risk. So we are lending out 95. So if 5 people didn't pay, we have some sort of a plan. Right? We have some sort of a plan if some people didn't pay. So if we receive 100 and pay 100, do we have anything to match that? No. So this is a risk mitigating measurement or not? This is a risk mitigating. Right? So you're like keeping something and lending out a smaller portion. So what you keep is known as cash ratio. So see, the amount kept by the bank is known as the cash ratio and is expressed as a percentage of deposited funds. So deposited funds, 5 is being reserved, so cash ratio is 5. The rest of the money can be used by the bank to earn money. So if the cash ratio is 5, then the bank can lend out the remaining 95% of any money deposited. It charges interest on this money lent out. That's the bank's business. It keeps some of that interest to make profit and pays some of it over the initial depositor's money as a reward for putting money with the bank. Now, remember, just like now, you are lending out this 95 now. For this lending, for this 95, you are receiving interest. Isn't it? Somebody who takes the loan, you are receiving interest. For the depositors, what with the depositors? Do we have to pay interest or not? You will have to pay interest. So bank's margin is somewhere here. If you lend this 95 at 10%, if you can give depositors the interest 4%, you are having 6%. That's banks. Right? Lending to huge rates, depositors to currently in the country, deposit rate is 2%, lending rate is 14. What's the margin there? Right? So next. So if 1,000 people all deposited $100 in the bank, totaling to 100,000 of deposits, and the cash ratio was 5%, the bank would have to keep 5,000 to hand and could lend out the remaining. Now, if the cash ratio is that, from whatever the accumulation of deposits, you'll have to maintain it as a percentage. Understood? Those who borrow the 95,000 then pay that money into other banks. Perhaps those of their suppliers whose bills they are paying with the borrowed money. This then starts another iteration of credit creation. That 95,000 is placed into various banks used by the suppliers who have just paid 5% of the total, will be kept in the reserve with the remaining remaining 95% being lent out. That means that another 95% of 95 becomes available to lend out as credit. So from deposits totaling to 100,000, borrowers have so far been able to get credit 95 plus this. It's happening like this. Now we lent out 95, right? Think this is 95,000. Right? If 1,000 people comes, this is 95,000. So this 95,000 again go and reach in another bank. Let's say supplier payment, so whatever. Now here in this bank, 5% remaining, 95% given. Right? So this 95% again coming back into the banking system. What will the next bank do? What will the next bank do? Now you have another bank. For this, 95 comes. But this 95 is inside the 100 that got deposited. Right? So from this 95, again they will keep a reserve of 5%. From this 95, again 95% will be lent out. Clear? Initially, we got and deposited 100,000. From that 5,000 kept, 95,000 gave as loans. 95,000 given as loans. That 95,000 comes into the banking system. Again 5% kept. 95,000 into 95% again lent. So this goes on increasing and increasing. Understood? The same amount of money which we gave is going and increasing and increasing. That is what you call credit creation. So from the 100,000 deposit, what's the total amount of loans we gave? 95,000 plus 90,250. Clear how credit it's getting increased and increased. That is known as credit creation. So this is the total. 90,250 and extra 85,250 appears to have been created from nothing. Depositors went and deposited only 100,000. But we gave loans 185,000. So this is happening for larger values and as a chain of iteration increasing. Credit creation. Those who understood? Right. Then this keeps on going and going every iteration of credit creation means that more deposits are made and more credit is therefore available to borrowers. To work out how much ends up being available in total. In total, remember, in total, we use credit multiplier. So credit multiplier is equal to 1 divided by cash ratio. Clear? So in this example, the credit multiplier would be 1 divided by 5%, which is 20. Okay? This means that the total change in deposits end up being actually 20 times the value of the initial deposit value. Can you imagine? Can you imagine how credit creation happens? So we were having the question, how do money comes into our hand? How do money notes come? Loans being given, deposits being given, financial system. So one student asked me about the money printing. I'll explain next week, right? This is how it happens. So 100,000 initial deposit would multiply up to 20 times their value, leading to a total change in 2 million. 100,000. 100,000 into 2 million. So banks is working with trillions and trillions. I think in our calculators, we can't type those numbers. Several number of zeros, right? So most of the time, this process works very well, but in times of extreme pressure on the economy, it can lead to negative consequences. At any time in this scenario, the bank will only have 5% of the deposits made by customers to hand. So as long as the customers in total want no more of that money back, the process works fine. This is high risk. So if as a whole, the customers want more than 5% back, the bank won't have the cash available. It has been lent. What do you mean by that? This creates the 100,000 we deposited created 2 million credit, right? But still, we retained only 5%. So can that match the total risk? Can that match the total risk? Definitely not. So if this goes on and goes on in the best way, it's good. But if something falls out, that's the end. So there are banks which has resulted in this, right? Silicon Valley Bank, Northern Rock Bank, lot of. So you may Google search and bring all this stuff. So credit creation is good only up until the point the depositors don't want that exact return of 5%. Only up to 5% if they are requesting, that's okay. But if they request more than 5%, the bank will be on. Clear enough? Right. So credit creation, again, I have given you an additional reading for you to read and understand. So simple this thing to do, you may read this and come. And also the question. Question number 3, please do and come. That's it for the week. So we'll finish it off this. So you'll be getting questions for your mock exam only up to this point, it seems, right? Okay, only 30 questions, just nothing. Okay. Yeah.